Good morning, students. Today we are going to understand the theory of analysis of financial statements. In that, we will understand about vertical analysis, common size, ratio analysis, trend analysis, horizontal analysis. And let's start the theory. Introduction. Business and non-business enterprise undertakes financial transactions. These financial transactions are recorded as per rules and principles of accounting. These financial transactions pass through different stages of accounting. The commencement of these stages is from journal entry. At the end of these stages, final accounts are prepared. We have undertaken that study in 11th standard in this regard. In previous chapter, we have studied final accounts of company. The components of final accounts are trading account, profit and loss account, which is also known as income statement, and balance sheet. These three are financial statements. Besides cash flow statement, fund flow statement are included in financial statements. These financial statements disclose the results of financial transactions of particular period of time. For example, what is the amount of gross profit? What is the amount of net profit? What is the amount of non-current liability? This kind of information can be ascertained from them. Financial statements represent historical information. These financial statements represent results of financial transactions of accounting period. In brief, profit and loss account discloses result of business, enterprise, and balance sheet discloses financial status of the business. Cash flow statement related discussion is undertaken in subsequent chapter. Cash flow statement also discloses the result of difference between cash inflow and cash outflow of financial activities of the business. The next, analysis of financial statements. Which tools are used? Which procedure is used for analysis? To whom is it useful? What are its objectives? Answers pertaining to these questions are to be studied in this chapter. Meaning of financial statements. Financial statements are those statements which provide the results of different financial aspects of the entity. Another meaning: financial statements are an organized report which disclose detailed financial condition of the business entity. Then, objectives of financial statements. First objective is to know the profit or loss of the business entity. Business entity undertakes revenue activities throughout the year. These activities are of two types, receipt and payment. If receipts are more than payments, difference is known as profit. If payments are more than receipts, difference it is known as loss. The information for such profit or loss is available from the prescribed financial statement. This statement is called as income statement. Therefore, the first objective of the financial statement is to ascertain the profit or loss of the business. Second objective is to know the financial position of the business entity. The financial position of the business entity is determined on the basis of difference of assets and liabilities. When the value of assets are more than liabilities, it is called as good financial position. When the value of assets is less than liabilities, it is called as weak financial position. This information is available from the prescribed statement, which is known as balance sheet. The second objective of preparation of financial statements is to know financial position. Third objective is to know the cash position of the business entity. The business undertakes transactions of cash receipt and payment during the year. The information about different sources of cash and application of cash is available from the prescribed statement. This statement is known as cash flow statement. The third objective of preparing the financial statement is to know cash inflow and outflow of the business. Then significance of financial statements. The information disclosed in the financial statements is useful to the existing and potential stakeholders. The financial statements are prepared to satisfy the different types of requirements of management, existing and potential investors, fund providers, short-term creditors, employees, customers, governments, and other different agencies. The financial statements are important for these stakeholders, but the analysis of financial statements accelerates the significance of these statements. Then types of financial analysis. Then these are the types of financial analysis on the basis of stakeholders, horizontal vertical form, on the basis of duration. Then on the basis of stakeholders, there are two types, external analysis and second internal analysis. Second, horizontal vertical form. First type is horizontal analysis and second one is vertical analysis. Third one is on the basis of duration, long term analysis, and second one is short term analysis. Then we will understand first on the basis of stakeholder. First, external analysis. When published accounts like income statement, balance sheet, report of an auditor or directors are analyzed by external parties like potential investors, financial institutions, government agencies, credit rating agencies, researchers, etc. for their investment related decision or for any other decision, it is known as external analysis. Then second, internal analysis. The management of the business take their decision from accounts prepared by them. The base of these decisions is analysis. When financial statements are analyzed by the management for their decisions is known as internal analysis. The information available for this kind of analysis is accurate and elaborate. Then second one is horizontal vertical form, and in that, first, Horizontal analysis. What is the meant by horizontal analysis? Then financial statements are prepared every year. The comparison of financial statements of different years is known as horizontal analysis. This analysis is done for long-term planning. This analysis is useful to know the current trend. This analysis is known as time series analysis. Second, vertical analysis. This kind of analysis is used to compare financial statements of 1 year. This analysis is used to compare the performance of different units or departments of 1 year with the help of different predetermined ratios. Then third, on the basis of duration, in that first, long-term analysis. Many stakeholders like debenture holders, financial institutions, potential investors undertake long-term analysis of financial statements before investing their funds in the corporate form of business. For this analysis, information of more than 1 year is needed. Under this analysis, these stakeholders determine the present and future long-term solvency, profitability, liquidity, and efficiency of the borrowers. In brief, under long-term analysis, the evaluation of above mentioned dimensions is done with the help of financial statements of more than 1 year. Then second, short-term analysis. This kind of analysis is used to measure short-term solvency or liquidity of the business entity. This kind of analysis is done by the short-term lenders as well as the suppliers of raw materials. Then next, objectives of financial analysis. Then first objective is evaluation of earning capacity. Generally, financial statements are prepared for the duration of 12 months. What is the earning capacity of entity during this period? This analysis is made with the help of different accounting ratios. Besides this, the future earning capacity of the entity also can be forecasted. Mostly all stakeholders for their investment decisions gather information of present and future earning through analysis. Second objective is efficiency evaluation. Business entity acquires different assets as per the nature of business. With the help of these assets, production and sales are done and services are provided. The use of these assets should be at maximum level. Maximum use of assets generate more earning. Through financial analysis, the evaluation of the efficient use of assets can be done. Third objective is solvency evaluation. Solvency of the entity is categorized into two types. First, short-term solvency, and second one is long-term solvency. Different parties provide goods and services to business entities on credit. The payment of these goods and services is to be made in short-term period. Therefore, the providers of goods and services measure the short-term solvency of the business. Financial institutions and banks also provide long-term advances to the business entities. They undertake evaluation and forecast of long-term solvency of business entities. Through financial analysis, evaluation of short-term and long-term solvency of that business can be done. Fourth, evaluation of managerial efficiency. The owners and the management are two different entities in the company form of business. Funds of shareholders are managed by the board of directors. Besides, officers execute the decisions taken by the board of directors. Therefore, through financial analysis, evaluation of effectiveness and fairness of the decisions of the board of directors can be done. The performance evaluation of the officers can also be done through this analysis. Fifth, planning for budget. Budget means the quantitative planning or statistical planning of future objectives in present what will be the future sales, how much purchase is required, how much will be the production, how much cash will be required, what will be the revenue expenses, what will be the capital expenses, etc. are estimated. Analysis of financial statement is useful to make the process of budget effective. Then sixth, comparative study. Two types of comparisons can be done through financial analysis. In the first comparison, the business entity can compare its current accounts with the accounts of past. Different aspects of business entity like profitability, liquidity, solvency and efficiency, etc. of the current year can be compared with the previous year to know the growth of the above mentioned aspects. In the second comparison, all these aspects of business entity are compared with the results of competitors. This is known as inter-firm comparison. Whether business entity is strong or weak as compared to its competitors can be ascertained through financial statement analysis. Then seventh, simplicity to understand accounts. Financial accounts are prepared on the basis of determined rules, principles and terminology. It is possible that all the users of financial accounts may not have full knowledge pertaining to financial accounts. Under these circumstances, financial statements analysis helps to understand the financial accounts. In financial analysis, the presentation of financial accounts is done in various ways. It provides simplicity to the users to understand financial accounts. Therefore, they can make their investments and other decisions. In brief, the financial analysis assists to understand the financial accounts. Then next, uses of financial analysis. Generally, four different aspects are analyzed from the analysis of financial statements. First one is analysis of profitability. This discloses the earning capacity of business entity. Second one is analysis of liquidity. This discloses the short-term solvency of business entity. Third is analysis of solvency. This discloses the long-term solvency of business entity. Fourth, analysis of efficiency. This explains the degree of use of assets. Next, limitations of analysis of financial statements. And first limitation is historical data. Financial accounts are prepared on the basis of past transactions. Thus, financial accounts are known as historical accounts. The analysis of financial statements is based on historical information. From this analysis, the future can be forecasted. The shareholders and other parties are more concerned with the future of business entity, which cannot be availed from this analysis, but the estimation of future can be made. Second limitation is ignorance of inflation. Due to inflation, information disclosed in financial statement does not represent the real status. Specifically, at the time of the valuation of assets, the impact of inflation is ignored in financial statements. Assets are disclosed at their old value and replacement cost, which is higher, is not considered. Income statement is prepared at current prices and balance sheet discloses actual prices of past. Thus, one statement is prepared as per current price and other financial statement is prepared as per the historical price. In brief, the value of money is not considered comprehensively. Therefore, the result as per financial statement analysis might fail to provide guidance. Third, absence of qualitative aspect. During financial statement analysis, only quantifiable items are considered, but factors like contribution of workers for development of business and loyalty of management towards business entity, honesty, expertise, etc. are not considered. All these factors have relation with efficiency of business, but these are ignored. This can also be considered as a limitation of financial statements analysis. Fourth, based on presentation of financial statements. The operation of analysis is done on the basis of information provided in financial statements. The correct and fair analysis and interpretation are entirely based on information disclosed in the financial statement. There is a direct relation between true and fair information and effective and efficient analysis. Thus, if information of financial statements is incorrect or inadequate, the true and fair analysis of information cannot be done. Here, the financial analysis is a dependent variable which is based on the appropriateness of financial statements. Next, fifth, personal opinion. There are options in accounting for preparing the accounts. For example, use of depreciation method, inventory valuation method. Thus, there is a possibility of personal opinion. Due to these options, there is a room for subjectivity in preparation of accounts. This also creates hurdle for financial analysis. Thus, it can be considered as a limitation. Sixth, window dressing. As stated earlier, fair financial analysis is based on the truthfulness of the financial statements. Many a times, the information disclosed in financial statements is not found to be correct. Accounts are prepared on the basis of incorrect information rather than correct information. Thus, decisions made by the stakeholders stand incorrect. This is also a limitation of financial analysis. Seventh and last, discloses only symptoms of problem. Financial analysis provides information of causes of the problems but does not provide the solution of it. For example, if company has expected 30% of gross profit and company earns 20% gross profit, the reduced gross profit rate can be seen through financial statement analysis. But why gross profit is reduced cannot be ascertained. The management has to find out the solutions and has to frame strategy accordingly. Then, significance of comparative financial statements. The importance of comparative statements can be described as under. First, intra-firm comparison. Every year, financial statements are prepared by business enterprises. When the accounts of business entity of current year are compared with the accounts of previous years, it is known as intra-firm comparison. As compared to previous year, whether the efficiency is increased or not, profitability is increased or not, whether the solvency is increased or not, can be analyzed. Besides, when one business entity has various departments, their financial performance evaluation is also done. This is also included in the category of intra-firm comparison. Second, inter-firm comparison. An industry comprises of various business entities. When financial statements of various business entities are compared with each other, it is known as inter-firm comparison. Which business unit is financially strong or weak as compared to the other business unit can be ascertained. This information is ascertained through inter-firm comparison. Different stakeholders may rethink on their investment decisions due to the inter-firm comparison. So, to undertake the financial condition comparison between two units, financial statement analysis is useful. Third, indicates trend. Due to comparison of financial statements of different years and different sections of a business unit, the information of trend pertaining of financial position and profitability is ascertained. On the basis of this trend, different stakeholders undertake forecasting of their decisions. The trend of different aspects is disclosed by financial statements analysis. The trend helps to make decisions. Fourth, useful to creditors. Creditors of business units are of long term and short term. Creditors determine credit worthiness of business units through analysis of financial statements, so it is also useful to the creditors. Fifth and last, simple and comparable presentation of information. The information disclosed in the financial statements is prepared on the basis of rules of accounting. But when the information of the financial statements is rearranged, it becomes simple to understand and analyze the financial statements. Generally, the information of financial statements is rearranged in the form of table. Thus, it becomes useful and simple to understand. Next, comparison of financial statements. Financial statements are compared in two ways. First way is through comparative statements. Under this comparative statements, comparative balance sheet and comparative profit loss statement means income statement are prepared. This comparison is done in horizontal form. Thus, it is known as horizontal analysis of financial statements. Under this comparison, it can be ascertained that as compared to previous year, what is increase or decrease in terms of rupees and in terms of percentage during the current year. The development trend of business entity can be seen from this kind of analysis. Then students, we also solve the sums related to comparative statements in the next parts. Second, through common size statements. Balance sheets and profit loss statements are considered for this kind of comparative statements also. This analysis is done in the vertical form, thus it is known as vertical analysis of financial statements. Under this comparison, one base is used. For balance sheet, the total of balance sheet is considered as base. Total of balance sheet means total liabilities or total assets. For profit loss statement, sales is considered as base. Next, characteristics of comparative and common size financial statements. First, there is information for 2 or more than 2 years. Second, the comparison of the results of 2 or more than 2 years can be disclosed in the form of rupees. Third, the comparison of the results of 2 or more than 2 years can be disclosed in the form of percentage. Fourth, this comparison discloses either increase or decrease. Fifth, The trend of any component of statement can be known through this comparison. For the example, the trend of share capital increase or decrease or no change. 6. It can be presented in ratio form. 7th, profit loss statement and balance sheet of the previous year are compared respectively with the profit loss statement and balance sheet of the current year. It means the comparison is done. Then students, इसी के साथ कंप्लीट होता है हमारा थियरी पोर्शन. नेक्स्ट टाइम मिलेंगे सम्स के साथ. स्टूडेंट्स, आपको हमारा वीडियो अच्छा लगा हो तो प्लीज लाइक शेयर एंड सब्सक्राइब टू सपोर्ट अस. थैंक यू स्टूडेंट्स.